Throughout this presentation, if you have specific questions, please write that in the comment box because we want to make sure we address those comments after this presentation so we can give you detailed, accurate advice and make this presentation as beneficial as possible for you and your family. Thank you for spending time today. I want to open up today's presentation with a brief story. Everyone was crying. You could just feel the sadness in the room. Then I saw a woman walk across this large room and give my father a big hug. My father then turned to me and said something to me that'll change my life to this very day. He says, "Son, people don't care about how much you know until they know that you care." And those words really resonated with me as a child. At the age of 9, I didn't know what I wanted to be when I grew up, but I knew I cared about people and I knew I wanted to help them. So that moment in time was actually at a funeral for one of my father's clients. My father was a financial advisor. Growing up, I learned so many lessons from both my father and my mother. One lesson was at the age of 16. A lot of my friends, they were given their first vehicles, but not my parents. They sold me their old Lincoln Town Car. And on top of that, they gave me a great interest rate, 10%. Now, at the time, I didn't like it. But over the years, I appreciate what they did. They helped me learn about interest and debt. And because of those lessons, I don't have any debt today. So growing up, seeing my father help his clients not only get to retirement, but through retirement, to make sure if they lose a spouse, that their spouse is going to be taken care of, to make sure they paid the least amount of taxes, and made sure, number one, they never ran out of money, I began to love the industry so much that out of school, I began working with my father. It's the only job I've had in my career, and it will be the only job in my life, which is helping families just like you have a safe and secure retirement. We have a comprehensive approach when it comes to retirement and financial planning. We have actually a trademark process called our Safe and Secure Retirement Roadmap. On that process, we cover 5 major financial pillars of a complete and comprehensive plan. That's broken down into 5 key areas. We're going to talk about taxes because it's a huge issue that we need to address. We're going to talk about investments. We're going to talk about income planning. We're going to talk about legacy planning and healthcare planning and show you how they're all vital and they all work together to benefit you. Now, technically, you can say myself and our firm were financial advisors. But what we really do for our clients is help you live a life beyond what you thought was possible. We want you to focus on making memories, not just making money. We want you to choose your today. Don't live someday, but choose today to do the things that you want to do. Because in life, you go from your go-go years to your slow-go years to your no-go years. And we want to encourage our clients to live the best life possible today. So taxes is the first subject we want to address. Now, when we think about taxes, a lot of people think, I want to save as much as I can in taxes this year. But our philosophy is a little bit different. When we look at taxes, we look at how do we save you the most amount of money over your lifetime. Many people that work with CPAs or accountants, they're very good history teachers. They look at last year's tax documents and say, hey, did you get a refund or do you owe money? When we look at your taxes, we look at the next 5, 10, 20 years. How can we save you the most in tax planning? But let's educate a little bit about taxes and the 3 major types of tax structures. This tax triangle, as you'll see, kind of lays out the 3 major types. First is your tax always bucket. On that tax always bucket, if you have interest, dividends, or capital gains, each year you have those gains or that interest, you get a love letter from the IRS in the form of a 1099 or a brokerage statement, and you have to pay taxes on that interest or capital gains. The second bucket is our tax when we take out bucket. Now, without knowing you, I know you. And I know the majority of you watching this today have most of your assets in 401ks, IRAs, 403bs, or 457s, because you were told for decades to defer, 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 because in retirement, you may be in a lower tax bracket. But the truth is, you may not. You may have done so well in those IRAs or 401ks that now when you need to take out the money and you're forced to take out money at RMD age at 73, you might be paying more taxes in your retirement. So anything you put in that tax when you take out bucket, you don't pay the taxes on it till you take that dollar out and then the taxes due. Now, the third bucket, which everyone likes, is the tax never again bucket. I should say everyone likes a tax never, but the again portion we got to focus on because you will have to pay taxes on your IRA money, whether you put into a Roth when you're working or if you convert from an IRA to a Roth. But once you do that, you will never pay taxes on that money again. And say hypothetically you have $100,000 in that Roth IRA and say that grows to $500,000, you can take all that money out tax-free. So our firm and our goal for you is to be diversified when it comes to tax planning. If you like, you can actually fill out a form that you can kind of sort out your money right now and see how much do you have in taxable or tax always accounts, how much do you have on what you take out or IRAs or 401ks, and how much do you have right now in Roth or tax-free accounts. Now, when you do that, you might see you're overly weighted to one sector. Maybe it's your tax-deferred area. Our goal is to have a strategic and smart plan to get more of your hard-earned money out of the IRS's control and back into your control. But let me ask a question. Think of this in your minds. Do you believe taxes will go up in the future? I gave presentations of over a few hundred people, and I asked that question, and usually I get 100% that say yes, because we have national debt. We have the stimulus from years past that somebody has to pay. We have government programs. By simple math, I believe taxes have to go up. So I don't know about you, but I love buying things on sale, and my wife especially does that as well. So I believe for a lot of our clients, we need to be strategic and smart and pay taxes when they're on sale. Maybe do incremental Roth conversions. Now let's talk about that. When you put money into an IRA or a 401k, you might have some restrictions on how much you can put in. But say you stop working and say you just want to move money from that tax deferred account into a Roth IRA. Is there any kind of income restrictions? No. You can do as much as you want. Now, we want to be strategic and smart and not do it all at once, but we can convert as much as we want from an IRA to a Roth IRA. When we do that, the tax is due that year we do the conversion. So let's just run through a simple simulation. Let's say you have $100,000 in an IRA and say you decide not to do a Roth conversion. And say that grows hypothetically at 7.2%. You may have heard the rule of 72. That 7.2% return on that $100,000 over 10 years, that $100,000 will double. So now you have $200,000 in an IRA. But then when you take that money out, what do you have to do? Well, you got to pay taxes on that. And hypothetically, let's say the tax rate is 25%. So if you take that $200,000 minus 25%, that leaves you with $150,000 that you can spend on your family, your lifestyle, and the things that you want to do. Now, that's if you do not do a Roth conversion. Now, let's look at that same illustration, but let's say you decide to do a Roth conversion. Say you take that $100,000 and you convert it into a Roth. Well, we have to pay taxes on that, so that could reduce it by 25%. So that means you have $75,000 left in that Roth IRA. If that grows at 7.2% for 10 years, that account will double and you now have $150,000 tax-free. So if we compare the two, the first one you have $150,000, the second one you have $150,000. What's the difference? The difference is you and I cannot control the tax rates. And if you believe taxes are going higher like I do, I believe now is the time to plan and do Roth conversions, to do tax planning before taxes go higher in the future. Now, let me add a little bonus tip to that. Let's say you do not withhold the taxes from inside the IRA. So remember that $100,000, say you do a Roth conversion, but you take some money to pay for that tax from your lazy money, maybe your checking or savings that's not doing a whole lot, and you pay that tax from that checking account. Well, that leaves $100,000 into that Roth IRA. And say that grows at 7.2% for 10 years, you now have $200,000 tax-free. But what if that goes up to $500,000? 100% of that is tax-free. So again, we want to have a plan. We want to do strategic and smart Roth conversions, incremental Roth conversions. But if you do so, that can literally save your families tens of thousands of dollars over time. Now, we in our firm, we take taxes so seriously, we encourage every single person for the first time when they come into our office or they work with us online to upload their last year's tax return. In 5 minutes, we could save you over $5,000 of tax savings. We look at your tax return, see what happened last year, see how we can plan for the future. Sadly, a lot of people, when they work with an accountant, they just tell them what they get as a refund or what they owe in taxes. We want to explain exactly what happened. We can even prepare your taxes. So our accounting team will actually prepare your taxes and send you a video recap exactly line by line what happened on your tax return. But when we look at your tax return, we're looking at how can we minimize the future tax. A lot of people, they are missing credits, they're missing deductions, or they didn't take advantage of the tax code for that last year. So we want to be proactive and see what can we do this year to minimize your overall tax. Now we're talking about taxes. Let's talk about those required minimum distributions. Now, a lot of people, they heard RMD or required minimum distributions. What does that mean? Well, what that means is once you reach the age of 73, as of right now, the government forces you to take money out of your IRAs, your 401k. Remember that tax and you take out bucket? They force you to take it out because they want you to go on vacation. They want you to enjoy life. They want you to spend time with your family and friends, right? Wrong. The IRS wants their revenue. They want the taxes to be paid, so they force you to take money out of your IRA to pay the taxes. Now, roughly at 73, it equates to about 4% of your IRA. And as you mature and as you get older, they want a bigger and bigger percentage taken out of your IRA account so they can get more tax revenue. But a lot of people don't realize that those RMDs can really affect their overall tax plan. Because whether you need to or not, if you're forced to take out a large RMD distribution, that can put you in the next tax bracket. That also can affect your Medicare excess premiums. So we want to reduce your taxes and reduce your RMDs. And how do we do that? Well, there's really two simple legal ways. The first is if we get the majority of all of your IRAs into a Roth IRA. Because if you have money in a Roth IRA, you don't pay any taxes forever. Once it's paid, you never have to pay it again. That's one simple way. If before 73, you move everything to a Roth. The second way is if you do a QCD, which stands for a qualified charitable donation. So say you take your money from your IRA and you send it directly to the charity, you have to be at least 70 and a half to qualify for this strategy. But if you send it from the IRA custodian to the charity, you legally don't pay any taxes on that. I had someone that came into our office for the first time. They were working with an advisor for over 8 years. They were in their late 70s, and they didn't realize that they could give to charity from their IRA and not pay taxes, which sadly the other advisor did not educate them on this strategy because they paid hundreds of thousands of dollars of excess taxes by not knowing this simple strategy. The only word of caution I have is you need to make sure your financial advisor and your tax advisor are working together in unison, because maybe you did everything right. You sent it directly from the custodian to the charities of your choosing. That custodian will still issue you what's called a 1099, which means that you have to pay tax at the end of the year. Now, if your accountant doesn't know that you did that to a charity and they don't code it as a QCD, you still might end up paying taxes on it. So again, make sure your financial advisor and your tax advisor work together in unison. Sometimes people say, I don't give tax advice, or go talk to your accountant. I believe, and our firm believes, that every financial decision has a direct tax implication. That's why we have a team of accountants and a team of advisors that work closely so when you ask a tax question, we can give you an answer in confidence. Now let's talk a little bit about our tax brackets. Every year they go up with inflation, to kind of adjust as time goes on. But some people don't realize that, how do I look at my tax rates? Do I look at my marginal tax rate? Do I look at my effective tax rate? Well, let me ask you a simple question. If we look at this year's tax brackets and say you're hypothetically in that 12% threshold, okay? Let's say that your boss felt very generous in December and they gave you a bonus, and that bonus was $1. And now they just bumped you into that higher 20-some% tax bracket. Is that a big change or a small change on your overall taxes? 85% of Americans thinks it's a very big change. But the reality is, it's actually a very small change in your overall taxes. because you're only taxed at that $1, whatever dollars over that threshold, at the higher 20-some% rate. So when we do tax planning, we don't look at what your marginal tax rate is. We look at your effective tax rate. When we average out your lower tax brackets with your higher tax brackets and look at your effective, your average tax rate, not only now, but for the next 5, 10, 20 years. And let's say hypothetically your effective tax rate is 15%. Well, that means for every dollar you made last year, 15 cents of that dollar went to the IRS. And you got to pocket, I would say 85 cents, but for a lot of us seeing this, you might live in Illinois, and we have a 5% Illinois state tax. So Illinois tax is at 5, federal's at 15 effective. That means you get to pocket 80 cents on that dollar, where 20 cents goes to the IRS in the state of Illinois. So our goal is to make sure that you pay the least amount of taxes and lower your lifetime effective tax rate. So we talked about taxes. Obviously, we coordinate that with an overall comprehensive plan. But the next thing I want to talk about is income planning. Income planning is vital. A lot of people, they have a portfolio. They don't have a plan. They got a 70-30, a 50-50, a 30-70 different stock and bond mix. When we look at income planning, we try to take the complex and make it super simple. So we divide money into 3 major categories. One category is for safety. So that money's there when you need it. It's liquid, it's available. If you need to pay for a new car, if you need to pay for property taxes, it's there when you need it. The second bucket is our income bucket. That bucket is specifically designed to generate income for maybe 5 years or 10 years to make sure you know where your income is coming from after you stop working. So that's the income bucket. The third bucket is the growth bucket. That's more long-term. We want to out-hedge inflation and get those long-term growth. So kind of what's inside those 3 buckets? Well, in the safe bucket, maybe you have your checking, your CDs, your money markets, it's safe and secure. Inside your income bucket, we're looking at investments that can kick out income on a monthly basis. What could that include? Well, that could include bonds. Bonds you can set out income on a monthly basis. That could include dividend stocks. Well, we're not looking for that high growth. We're looking for the consistent growth, but more importantly, the consistent dividends that'll pay out on a monthly basis to support your lifestyle and your income needs. Another thing that people may not have heard of is structured notes. Structured notes can give our clients a guaranteed yield between 10 and 15%, and that interest is paid out on a monthly basis, so 1/12 of that rate, each month to satisfy their income needs. So that's a great way to take minimal risk, but still get very competitive income for their family and their income plan. Another option might be real estate. Maybe you have a rental property, or maybe you invest in REITs that you can get that income on a monthly basis. And lastly, let me ask a question. Think about this in your minds. Do you like the thought of more guaranteed income inside your financial plan? If you said yes in your mind, you probably like annuities, because annuities are the only way to guarantee you income forever on a monthly basis. So for some people that are more conservative and they want guaranteed income, annuity could fit that bucket. So that's kind of what's inside the income bucket. What's inside the growth bucket? You probably guessed it. Equities, stocks, mutual funds, ETFs, long-term growth vehicles. But some people, they don't want to deal with the roller coaster of the stock market. You know, maybe they already won the game. They have assets. They just don't want to see them go down. They just want to kind of only go up and never go backwards. Well, we sometimes create a separate category for that. We call it CG, or conservative growth, where you can make 50 or 60% of the S&P 500 returns, but take no market risk. So if the market's up 20%, you can make double-digit returns. So for people that never want to go backwards, kind of want that staircase approach that they can only go upwards, sometimes we put that inside the portfolios. So just let's run through some numbers and put some kind of color to this equation. Let's say hypothetically, you have $1.5 million in total assets. We might allocate about $100,000 to that safe bucket so it's there when you need it. Now, let's say that you have, you need income needs. Now, your income needs are about $8,000 a month, but your Social Security benefits only about $4,000 a month. Well, we got about a $4,000 gap. So we got to solve that gap. So we might put $800,000 into that income bucket to kick out on a monthly basis that $4,000. So now all of your lifestyle expenses are taken care of with your Social Security and the income that we're providing. So that now allows you to put an extra $600,000 into that growth bucket because your lifestyle's taken care of, you have that income coming in. So even if that growth bucket goes down a little bit, you're not going to be nervous or stressed. You're not going to lose sleep at night. Your income's going to be taken care of regardless. So when the market recovers, you can actually participate in that. And for our clients, when the market dips in that growth bucket, that is not a time to reach out and say it's just a paper loss or just hang in there. That is a time we provide financial leadership. That is a time we take action because maybe we want to do a Roth conversion at that lower threshold then. So when the market recovers, it recovers tax-free. We did a lot of that during the pandemic. When the market took a dip and we had a plan, we didn't kind of just hide from looking at our statements. We told our clients to do Roth conversions because when that market did recover, it recovered 100% tax-free on that Roth portion. So again, simple safety income growth. We can do that for you if you'd like and kind of align your money to your goals. Or a lot of people have an investment here, a stock account here, this, and this, but it's not all working together and the investments are not aligned to the purpose. Is it for safety? Is it for income? Is it for growth? We can kind of reorganize and help you have a better alignment when it comes to your income plan and make sure that you never run out of money and you have peace of mind throughout your retirement journey. When it comes to income planning, the biggest source of guaranteed income for many people is coming from Social Security. A lot of people have a question, when's the best time to take my Social Security benefits? Should I take it at 62? Should I take it at 66 in a few months or full retirement age? Or should I wait to 70? I'm going to tell you the answer today. The answer is, it depends. It depends on so many different factors. Let me give you a story. Let's say a married couple, one of the husband, he comes home from work one day and he's just fried, he's 62, he's just, honey, I can't work anymore, I'm gonna retire and I'm gonna turn on my Social Security benefit. His spouse has also been working for decades too. She was raising the family, taking care of the household, but her career earnings or her Social Security benefits were not as high. He takes it at 62, they get a 25% reduction in total benefits, and say, God forbid, he gets in a car accident. His spouse, her surviving spouse, is left with a reduced benefit for the next 20, 30, maybe 40 years. Or what if you delay it and what if you wait till 70 and you get the biggest paycheck and you're happy, but you didn't live past 75? Was that a good solution? Well, probably not. Our goal is to get the biggest pile of money from Social Security, not just the biggest paycheck. So when we look at Social Security, we combine that with your overall plan, but we also want to ask you, how is your health? How are you doing? One, because we care about you. We care about our clients. We want to see how you're doing physically and health-wise. But two, each and every year that helps impact the decision making on, do we delay Social Security or do we put on Social Security? If you delay Social Security, you get roughly an 8% bump up in those benefits till the age of 70. But that doesn't mean you have to wait till 70, turn on the highest paycheck, so to speak, because maybe your health isn't good enough to last many years. Or what if you have a family history that everyone in your family passes away at 62 or earlier? Well, I want to turn my Social Security benefit on right at 62. So again, our job is to look at the big picture and the plan and see how we can maximize your Social Security benefits so you get the biggest pile, not just the biggest paycheck. The next thing I want to talk about is investment. And I believe most advisors, they talk about investments first and foremost. How much can I make you? How can I grow your assets? But as you kind of already have heard, it's not about how much you always make. It's about how much you get to keep when it comes to tax planning, when it comes to making sure your lifestyle is taken care of and what investments to use. Most people out there and most advisors, they try to promote an investment or a product where they make the most money and that's what they like. I'll tell you, at our firm, as fiduciaries, as looking at the big picture, we don't care what tool or what investment or what product, as long as it accomplishes your goals. So we can do investments that have more risk. We can do investments that have no risk, right? We just want to get to know you and then create a plan. So again, for most people, investments is the main thing and then what they do. We believe it's important. We want to get competitive returns, but it's only 20% of a complete, comprehensive financial plan. But one thing that some people haven't heard of before is maybe structured notes, which I mentioned earlier. Maybe you don't want to take a lot of risk and you want to minimize the downside, so we can do buffered ETFs. Maybe you don't realize that you can actually grow your assets and get income out tax-free by using Section 7702 in our tax code. Kind of use a different strategy to get more growth and then get income. Lots of these things are just the tip of the iceberg on different investments you may never have heard of, because maybe your advisor doesn't do it, maybe they're not educated, or maybe they're not comprehensive when it comes to what they can offer. But our job as our firm is to educate, give you the pro, give you the con, and help you be comfortable with whatever investment decision you make. I'll give you a brief story. Joe and Sally, they were on a road trip to a resort destination in Arizona. And Joe saw the sign with Sally that said 100 miles the next gas station. They look at the gas gauge. They had about 150 miles left to empty. So Joe said, we can keep on going. Sally's like, we should have stopped. But they keep moving forward. So then they pass another sign, 50 miles to the next gas station. They look at the gas gauge and they have 75 miles left to empty. Joe's like, we're fine, we're gonna make it. Sally's like, you should have stopped. And they pass another sign, 20 miles to the next gas station. They look at the gas gauge, 25 miles left to empty. Joe's starting to sweat. Sally's nudging him, saying, you should have stopped back there. But then they arrive with 1 mile left to go in the gas gauge. And Joe's like, I told you so, we made it, we're fine. They walk in, they check in with the lady at the front desk, and she greets them by saying, wasn't that the most amazing drives of your life? That road is rated top 10 on National Geographic. What did you think? Joe and Sally just thought about it, looked down, and realized they were so focused on that gas gauge. They weren't looking out. They weren't enjoying the view. They weren't looking out the windshield. We as a firm don't believe we want you to look at the gas gauge. We don't want you waking up every morning checking your statements, and if the market's up, I'm in a good mood, I'm going to go out to dinner and have dessert. Or if the markets are down, I'm not going out to dinner, I'm not going on vacation, or maybe you're in a bad mood. We want you to truly enjoy life, make memories, have experiences, truly do what you want to do in a day-to-day. Choose your today and don't let the market or economic conditions dictate that. A lot of people ask, how do you get compensated? How do you make a living? And the truth is, we get compensated two different ways. One way is we get paid directly from an insurance company for recommending a product that serves your goals and serves your plan. So let's say hypothetically you want to leave a legacy to your beneficiaries and you want to get a life insurance product, and say that product is with ABC Company for $500,000. You can go directly through that company, or you can work with us. It's the same $500,000 death benefit product. The difference is, if you need a question answered, you need to call someone, you can call us instead of calling 1-800 whatever that company is. Now, we do get paid directly from that insurance company for recommending a product that fits your goals. Or the second way is, if we manage your assets, the more money that you make, the more money that we make. So we do have a management fee on that and have a vested interest to grow your assets over time. That's usually for people that are maybe more aggressive, or some people want to be more conservative and maybe they go into an investment that has no fees, has no risk, and that's just going to depend on the plan. But depending if it's with an insurance company or we're managing the assets, those are the two ways that we make a living. Our job is to educate, make it very clear how we get paid, why we get paid, and how these investments or products fit your overall plan, and make sure you are comfortable with whatever decision we come to. Okay, let's move on to the next subject. Let's talk about healthcare planning. Okay, when it comes to healthcare planning, we want to make sure that we're broad in our scope, that we have a plan for your Medicare coverage, we have a plan for your long-term care coverage. Over 50% of us will need some form of long-term care in our lives. Sadly, less than 50% actually have some long-term care coverage. So we want to make sure that we at least give you some options, see what you can even apply for and get, and make sure we leverage long-term care to give your family peace of mind. Because the statistics say we will probably need it, we want to make sure we're covered for it. I'll give you a brief story. A lady named Jane. Jane had this old life insurance policy, and she's like, Jordan, I don't need this policy. My kids are set. I don't want to pay into it every month. I said, let's review that. Let's put that as part of the plan. Now, Jane, her big concern was actually long-term care. So what we did is we looked at her old policy for life insurance, and we were able to actually have her stop paying into that whatsoever. So she paid no more into that policy. We took the cash value from that old policy and we put that into a new policy to give her a bigger death benefit, but more important to her was long-term care. And it was going to give her over $19,000 a month in long-term care benefit, and she didn't pay one extra dime into that policy. So a lot of people don't realize life insurance, yes, a lot of people think that only the beneficiaries benefit, but you need to think differently about life insurance. You can use your life insurance while you're still alive. If you get sick or need long-term care, you can take from that death benefit tax-free and use that death benefit while you're alive, while you're still living, to benefit for long-term care. Again, maybe it's a concern of yours, maybe it's not, but you owe it to yourself and your family, if you have an old life insurance policy, to get it reviewed. So another thing we do for healthcare is we want to make sure that you have all your powers of attorney set up. So we want to make sure you have your healthcare power of attorney set up and you know who can make those legal decisions. Also, we do Medicare in-house. We have our Medicare team that can help review your coverage each and every year, or once you approach 65 or you leave your employer, they can help you get onto Medicare and find the right plan and review that on an annual basis to make sure you pay the least amount, but you get the most coverage based on your individual health needs. A lot of our clients, as they get older, they have questions, so we have an entire team to help on the Medicare side. The last bucket I want to discuss is the legacy bucket. We believe it's vital. If you work so hard for 20, 30, 40 plus years, you did so many sacrifices for your family, you want to make sure that your assets transfer smoothly to the next generation. You want to make sure they go to who you want it to go to. You want to make sure you avoid paying the IRS any more than you legally have to. So that's why we believe in having a legacy plan, making sure we have trust set up, making sure we have powers of attorney set up. Now, the simplest way to avoid probate is to name a beneficiary on the account. But let me tell you a true but sad story. A few years ago, one of my clients, they referred their sister to our firm. And she came in with all these paperwork and all these statements, and she had tears in her eyes because she tragically lost her husband unexpectedly, and he was in his mid-50s. Now, her husband was very successful, very smart man. He did everything himself. I like to say he's a do-it-himselfer. And he had all his investments. They had over $5 million. But within 5 to 10 minutes of looking through her statements, we quickly identified that there was not a beneficiary on any of these accounts. So I told the lady, I said, we have to go through probate. We're going to have an attorney to walk you through that, but we're going to be with you every step of the way, and we're going to make sure this gets done for you. But all of that could have been avoided by just putting a named beneficiary on the accounts. It's very simple, but some people just do not do that. So I encourage you tonight to look at all your accounts, make sure there's a beneficiary on that account. Make sure it's who you want it to go to. So that's the simplest way to avoid probate. We can also set up trust, so you can even have control after passing or have protected for legal matters. Maybe your in-laws become outlaws or situations change in your family. I'll give you an extreme, but it's a real circumstance. Say, God forbid, you and your spouse are in a car accident, and in that car accident, you guys do pass away. But in the midst of passing away, your son or daughter and their spouse, they were going through marital issues and they were about to get divorced. And that nice person they thought they were was not such a nice person. They're in the process. If those assets transfer before they legally divorce into your son or daughter's name, their about to be ex-spouse can legally be entitled to that asset. But if you name a trust as a beneficiary, we can legally protect those assets so it stays in the family, it stays in the bloodline. I know that's an extreme case, but this happens day after day. So we want to make sure that we have a trust set up for our financial clients. We can even create that free of charge. We believe on creating these legal documents so that you have everything under one roof. Now, a lot of you watching this, you may be financially successful. We want to make sure that we help you continue to win the game and look at other opportunities that you may not have even seen. The reality is, a lot of people today are taking probably too much risk than they're comfortable with. A lot of people, if you're a football fan, I'm a football fan. If you're in the fourth quarter and you're up by 30 some points, you're probably not throwing Hail Marys and deep passes. You're running the ball, you're running out the clock because you just want to win the game. Many of you watching this today have already won the game. You do not want a major market correction to derail your financial freedom, your peace of mind, and derail your portfolio. We don't want that 401k to become a 201k. We want to make sure we protect you before the next event occurs. So again, it's about a comprehensive approach. Okay, whether you have $500,000, $1 million, over $5 million, we are looking forward to and excited about creating a financial plan that you can be confident in. Picture a day where you're writing a check to the IRS and you're actually smiling while you're doing it because you know you're paying the least amount of taxes possible. Picture a day where your grandchildren come up to you and say, "Grandma, Grandpa, you look like you're enjoying retirement. You're having so much fun." Picture a day where you're no longer looking at that gas gauge. You're no longer worried about the market returns or what's going to happen in the economy, and you're just enjoying life, doing the things that you want to do on a day-to-day basis. After a presentation like this, a lot of people wonder, "Hey, Jordan, how can I meet with you and your team, and how can I put a plan into place?" Well, the first step is an introductory call. It can be 15 minutes. We get to know you, get to know your concerns, see if we're a good fit to get to know and help you in your financial goals. And then after that, we can sit down, whether it be over Zoom or in person, and make sure we put together a plan that you can have confidence in. Again, our goal is to give you the most value and be honest, transparent, and give you the pros and the cons. I want to conclude with one last story. The story is about 12 years ago. A beautiful blonde walks into our office for a job interview, and we liked her credentials, and we gave that beautiful blonde a job. About a year after that, I asked that young lady on a date. And about a year after that, I proposed to my now wife, Anna, at an ice skating rink in Colorado. I'm not even a good ice skater. I basically was on two knees begging her to marry me. But because I chose to take action, because we made that commitment and I asked her to work or to date and then to get married, I've been so unbelievably blessed in my life. We've had 10 plus years of a great marriage. We have a beautiful son named Jaden. And I say that story to you today because if you like some of the things we can do, if you see the value that we can provide, I encourage you today to take action. We hope to work with you and our future clients for decades to come. We do not want to be transactional. We want to be transformational in you and your life and actually encourage you, nicely nudge you, and challenge you to live your best life, to live a life beyond what you thought was even possible. So I challenge you to take the first step and book that 15-minute call and see if we can make an impact in your life.